Hey everybody, and welcome back. Today's topic is going to be how to beat the heat of interest rates. Stay tuned and we'll go over the details right now. So first question, why do we need to beat the interest rates? In order to answer that, we kind of have to talk a little bit about what actually happened in 2022. Over the last decade, we've been experiencing a boom in the real estate business. That may sound familiar to anybody who was in the market in 2008 or 9 when it was like the bubble's gonna burst. And that topic and conversation has resurfaced. We're not gonna cover what's gonna happen with the market in this video. You can tune in to later videos and we will have that content for you. But today's topic is going to be about how to beat the current rates. But before we do that, let's cover the rise of interest rates and what specifically happened in 2022. Rates in 2022 began much like they have been over the last decade. Now it has fluctuated some, right? I mean, fives were common, and then we saw fours come in. Threes were like a dream. And then all of a sudden we started dipping into the twos, and that almost became normal. Right? Very brief window.
We haven't had to have this conversation in a long time. I mean, the past, if you look back over the last decade, I mean, yes, with fluctuation into the fives, but I would say the majority of the time you've seen rates in the threes and the fours.
Threes and fours have been the common thing, and that's how we started this year. What was the prevailing interest rate? I mean, granted, there's some fluctuation, but what did you see commonly in January of 2022?
So 3.5% was back in December and January. When I look back at clients that we did a pre-qualification on or a pre-approval on back in November, October, December of 2021, I had run those qualifications at 3 and 4% rates.
Okay. So that's what we were commonly seeing was around that. Now let's fast forward. We're in December of 2022. What's today's rate running? Obviously there's. I hate this question.
Yes,
I
understand.
So what is the rate on average right now?
I'm gonna talk in general about the market, not necessarily what my rates are at Southeast Mortgage, but I would say you're pushing a 7% 30-year fix right now.
Right now with today's rates.
With today's rates, absolutely. That is probably a decent average. I mean, you can see we've locked rates in the last 30 days at 6.75. But I would say for the purpose of the video and to just kind of compare, you're pushing 7%.
Okay, so we're pushing 7%. We started in the threes, low threes. Now we're pushing 7%.
And
what has caused this rocket ship to go up? Now I would say, everybody's experienced the prices doing that, but interest rates stayed low. So what has caused interest rates to all of a sudden turn north as fast as they did?
Yeah, if you had to boil it down to one word, it would be inflation.
Got it.
And this rise is so unique because it happens so quickly. I mean, usually if you're going to see an interest rate, a mortgage rate, increase from the 3.5% rate to a 7% rate, that's something that would take a year and a half to accomplish.
Wow.
This happened in a matter of 6 months.
Yeah, I would say because even the first part of the year we still were in the threes pretty aggressively, and it wasn't until you started getting towards after first quarter when you started seeing some of it pop up, and then by third quarter it was a rocket ship.
And the Federal Reserve's mandate, really their reason to exist, is to keep inflation under control. Their target rate of inflation is 2% a year, 2% increase year over. In inflation numbers. They were clipping along earlier this year at 8%, 7%, 8%. It was really, really, out of hand, and it's really unhealthy for the economy as a whole. And so they have to get that under control, and they have to get that under control as quickly as possible.
Okay.
So what ensued were, 4 3/4% rate hikes in consecutive policymaking meetings. So instead of this being something that happened over the course of a year or 2 years, this is something that happened over the course of about 3 or 4 months.
Got it.
And it really just, and that's why we're having these conversations around, affordability on mortgages as well as affordability in the housing market.
Got it. So in order to combat inflation, they went ahead and started turning up the heat on rates. Basically, and just so this is clear to you, why would they do that? It's to literally slow the economy. I mean, if you ask, depending on who you ask, it's to put a bullet in the head of of the economy. Which, I mean, if you want to relate it to speeding, is we've been going over 100 miles an hour down a 30-mile-an-hour road for a very long period of time, and rather than letting off the accelerator and slowly bringing it back down, we waited too long to slow the speed down. So it's equivalent of taking your foot off the gas and hitting the brakes hard and creating this feeling which is giving everybody nausea. And so question number one, what is a 2-1 buy down?
It is a temporary reduction to a mortgage note rate where you reduce the rate by 2% year one.
Okay.
Year two, the rate's reduced by 1%. Year 3 through 30, it goes back to the note rate.
Okay, so it's a temporary buy down on the rate that lasts for basically 2 years, like you just said, 2% first year, 1% second year,
That's it.
And then it returns to normal. So what's the estimated cost? I mean, I assume something like this is going to have some fees in it.
Yeah, absolutely. So if I was to use a concrete example, I would take
Let's
a $450,000 sales price, let's say.
Let's
say you've got a customer putting 20% down. They want to do a 30-year fixed rate mortgage.
Got it.
30-year fixed rate mortgage today for them would be a rate of 6.75.
Got it.
We're gonna give them a 4.75% payment year one.
Okay.
Which is going to reduce their payment by about $474 a month.
Okay.
Okay. Then they're going to make that payment.
Okay.
That reduced payment for 12 months. Okay. Then in the 13th month, in year two, first month of year two, that's going to increase from 4.75 to 5.75.
Got it.
Okay. Remember, we started with a note rate of 6.75.
And that still is the note rate.
At 5.75.
Got it.
That's going to be a reduction of about $232 a month in mortgage payment, and they're going to make that payment for 12 months. The rate is then going to return to the 6.75% for the rest of the loan.
Got it.
So you get 2 years of decreased mortgage payments.
Okay. So let me ask the question, the elephant in the room.
Yes.
Why in the world would you spend the money for just such a temporary solution?
Because you anticipate that within the next 2 years, you're going to see rates back in the 4s, maybe 5s, somewhere in that, somewhere significantly lower than we are now.
Got it.
You feel like if rates were at the 4 or 5% level, a particular house might be more affordable for you. Your situation might be different 2 years from now for a number of given reasons.
Temporary solution.
But you anticipate that those rates are going to drop between now and the next 2 years.
Got it. So it's a temporary solution to the issue. Makes perfect sense to me. Okay, so now comes the other elephant in the room: is what does it cost to get one of these bad boys?
Absolutely. So basically, if you in that $450,000 example where a customer is putting 20% down, that buy down was costing about $8,200.
All right. So here's the problem: if I'm doing the math correctly, if it's going to cost me about $8,200, I'm going to save somewhere in the vicinity of that. So why give you the money today to basically save it over a 2-year period and still have to refi? Why would I?
The idea today is that you wouldn't be the one paying for it. Yes, you could put your own money into a separate account that you could use to subsidize your own mortgage payment. What we hope to accomplish is that the seller contributes to that buy down.
Got it. All right, so then that brings up the interesting question is, from a buyer's perspective, it makes perfect sense to ask the seller to come up with the extra $8,200 to make this more attractive for you, but why would they?
Yeah, absolutely, because there's going to be more benefit to the buyer at the end of the day to reduce their mortgage payment by $474 a month in year one, $230 a month in year two, than there is to just take a straight reduction to the sales price. The amount of interest that they'll save over that 2-year period is greater than the amount of interest that they would save just by borrowing $8,000 less on the mortgage.
Got it. And so the reality is going to be the benefit for a seller. If you're a seller out there going, why would I pay this $8,000? Well, there's fewer buyers in the market because interest rates have taken many of the buyers out. Those buyers that could afford a $450,000 house at 3.5% interest are out of the game if that was the cap, right? They're no longer in the game. So in order to get some advantage back into the situation where you can attract some of the fewer buyers that are in the pool to you is by offering a lesser interest rate, a reduction on the sale price of your house. What you could do is offer a 2-1 buy down so that they can get in at a temporarily a lower rate and then refinance out of it. So it's the definition of a win-win scenario potentially
for the seller and for the borrower.
Yeah, that makes sense.
Absolutely.
That makes sense. If I'm concerned about what happens if the economists are wrong, right? You know, and the rates don't, and I want a more permanent solution, is there anything available to me to mitigate some of these interest rates now that isn't such a short-term fix?
Definitely, yeah. Yes, the 2-1 buy down implies temporary. Right. And what I would say is there's also a permanent buy down available, which many times can be as good or a better option for some people, like you said, that are nervous Neds that are going to be up at night concerned about what's going to happen, 2 years down the road.
Right.
And so, yeah, I would say if you looked at the same scenario and you were just to use the same $8,000 that you used to do a temporary buy down to permanently buy the rate down, then you would in as a general rule of thumb, 2 percentage points of your loan amount is going to reduce your interest rate by 1%. Okay, by 1%.
Right. So you're going to pay a fee of 2 points, and you're going to end up with 1% less in the interest rate.
So instead of 6 3/4, you're going to go down to 5 3/4 on that 30-year fixed rate using 2 points, and that's in the earlier example. But it's not going to ever change.
Right. But now you have that stability, right?
Ever.
So if stability is your thing, that solution, although it's a lesser buy down, it's still it's permanent, right? So you get to ride out that interest rate. If they never come back down, or let's say they climb up to 8 and then bounce back to 6, you're still at 5 3/4 in that scenario. So that's a great workaround for you there.
And usually these discussions are had between a loan officer and a borrower, and through the course of the conversation, learning about whether you're a nervous Ned, whether you might. Many people, before, as we're suggesting these products, are already asking me, can we refinance this thing in 12 months? Can we refinance this thing in 24 months? Well, absolutely you can. If you've already got plans to kind of do that built into your calculation of what the risk is going to be, then the 2-1 buy down becomes a lot less intimidating, a lot less risky. It's a fixed rate mortgage, so it's not, it's those first 2 years, and that 2-year window is an improvement over where the long-term rate is.
Okay.
But if you know what that long-term rate payment is, that payment would never rise beyond that. Beyond those first 2 years, you just get the benefit of the initial reduction.
So in loving government math, we just talked about a permanent fixed rate mortgage whose rate is not actually fixed. On the front end, it moves, right? And it's lower and then comes back up to normal, which is why I to explain that. Let's now explain the opposite, which is what everybody used to be freaked out about, which is adjustable rate mortgages that happen to be fixed for a period of time. The dreaded ARM product. Okay. Everybody got into them because it's like it's adjustable, but it's actually fixed. And so without rehashing the past, what does it look like today?
Yeah, no problem. So you've got it offers an initial lower rate without the cost of a buy down.
So you're not going to have the extra 2 points.
Not going to have. It's not going to cost you $8,000 to do. It's not going to cost somebody $8,000 to do. It just is that the loan is structured in such a way or set up in such a way that the initial 10 years of the loan are at a particular fixed rate period. Then after 10 years, it will adjust based on what the market's doing 10 years from now. But the initial 10-year rate is going to end up being about 1/4 to 0.5% below where the current 30-year fixed rate is.
Okay, so let's use the same example.
The difference is not as big or stark in the short term.
Got it.
But if you know and you have a high degree of certainty that something is going to happen in that 10 years, like my employer's moving me, my kids are graduating from college, and we're going to downsize to a smaller home, grandmother was going into an assisted living facility. If we know there's an event that's going to happen in the next decade, then to take that 1/4% lower in rate, it might not push you into the market when you wouldn't otherwise be there. But if you know that is going to happen, then people will use that, because why pay 1/4% higher if you know you're not going to be there 30 years? There's no way. Got
it. So this is basically an interim example of I'm a little bit of a nervous Ned. But 10 years worth of stability is more than enough, because I know that I've literally haven't stayed in any house that I've had in my adult life for 10 years. Therefore, this is going to be the perfect thing for me. So just to be clear, it's between 1/4 and 1/2% better. So if I'm using the same example, 6.75 might be 6.5.
That's right.
Or if I'm lucky, 6 1/4, somewhere in that window, maybe 6 3/8.
Yes.
Somewhere in that window. And it's going to be locked for a decade in this particular scenario, and then becomes adjustable once a year, depending on what interest rates are doing.
But not for 10 years.
But not for 10 years. Not for 10 years.
Yes, correct.
So, but it's a 30-year loan. That the front end of it is locked for this period of this decade.
Mm-hmm.
The last 20 years of it, it's adjustable, where the 2-1 is it's lower for the first 2 years and then adjusts up to the 6.75 and remains it for the rest of the 30 years. So there's a couple options, things you can pull out of the tool belt that might work best for you. So those are awesome. Those were 3.
A lot of the questions that we'll ask, just as an aside, when you're talking to a borrower about what their plans are, is how did you treat your existing mortgage? I mean, so if you've been in your house for 7 years, did you only take out the mortgage you used to buy the house? No, I refinanced it, one time in that 7 year. Well, okay, so you did 2 loans in 7 years, or a loan every 3.5 years. That'll allow you, if you just look back over your past behavior, when you're trying to think through the risk assessment of whether it makes sense to do a buy down or an adjustable rate mortgage, just ask yourself, how you treated your previous mortgage, and that'll give you some kind of idea of whether the impact of having to refinance that again 2 or 3 years from now.
Got it. Perfect.
What that feels like.
All right, so if you're in the market or you want to be in the market and interest rates have you frozen on the fence and you need a solution to thaw it out, make stuff move, then what I would say is give us a call and we can walk through that process and how it might impact you and what's going to be the best solution for you, because this is an ever-changing situation that will constantly be evolving, where different tools are needed, and what we're experts at is bringing the right tool at the right time for you to get the right result.
We want to listen to your story, we want to hear your situation, and then we want to try to apply and help you manage the largest debt. That's what I want to do, is help you manage the largest debt that you're probably going to encounter in a way that allows you to accomplish your end financial goals.
Awesome. So, Chris, how do they reach out to you if they need to get a hold of you?
Absolutely. 404-735-3111 is my mobile phone and my business line, and that would be the best way to reach me.
Great. If you guys found value in this content, please remember to subscribe below and give us a thumbs up. It helps the algorithm to be able to tell us to put more content out like this. We appreciate you so much, and we'll talk to you soon.
Thanks, Jason.
Yeah. All right, so we got that.
Okay, better.
You feel good about that?
I feel good. I feel like
What is a 2-1 buy down?